Well, in its fight to rein in soaring prices in the world's largest economy, the US central bank has hiked interest rates by 75 basis points for the third consecutive time. The increase takes target policy rates to the range of 3 to 3.25%. The Fed Chair, Jerome Powell, says that the rate rises were necessary to avoid long-term damage to the economy.
Today, the FOMC raised its policy interest rate by 0.75 of a percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%.
Powell further signalled that there will be additional large increases in the future to combat inflation that remains near a 40-year high.
So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And, you know, that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place.
Well, for more on this, our US correspondent Susan Tarani joins us live from New York City. Susan, what did the Fed have to say about this latest interest rate rise?
Yeah, Nick, it's interesting that it seems like it shows that the Fed knows that unemployment will be on the rise, but it's determined to increase interest rates and to bring down inflation at whatever cost. And I think so much for that soft landing that they were talking about earlier in the year. I think these are pretty aggressive moves, and the Fed has acknowledged that. I think it's saying by the sound bites that you just played right now, it's indicating that it is going to continue and to buckle up until the inflation comes down at whatever cost. And altogether, I think it also signals that this pessimistic outlook that is paired with this interest rate that we're seeing right now, it's ultimately going to have a broader toll on the entire economy moving forward as we enter the next quarter.
And Susan, how have US markets reacted to the news of this latest rate hike?
Sorry, I lost you there.
Susan, I was just asking, how did US markets react to this latest rate hike?
Yeah, the markets were very jumpy. I mean, we did hear that the dollar was hovering at a 20-year high yesterday, and it's expected to remain pretty strong compared to the euro in the short term. Analysts aren't making any predictions in the long term. But then I just want to note that, you know, while we do have a strong dollar right now compared to the euro, the pound is also playing pretty strong as well. And also another thing that's really helping the dollar at least is this statement or announcement that Vladimir Putin made yesterday that he would bring in reservists for the invasion of Ukraine, just because the dollar is sort of considered to be a haven currency in times of geopolitical turmoil and economic stress. So, you know, that's something that we saw on the side as well.
Susan Tarani joining us live from New York City. Thank you, Susan. And we're going to get more on this from Sultan Meghi, the former Chief Innovation Officer and Duke Professor and Scholar at the Carnegie Endowment for International Peace. He's joining us live from Washington, D.C. now. Well, look, 5 rate hikes already this year from the US Federal Reserve, but we're still seeing inflation stubbornly high. What's your assessment of the Fed's moves so far?
Well, the Federal Reserve has had a tough game laid out in front of it, and by choosing to act in a more subdued way earlier this year and late last year, they're in a position where they've kind of boxed themselves in the corner, and they're going to have to continue to keep raising rates at this kind of level for at least one or two more cycles. The target rate is probably going to end up being more 4%, 4.25%, 4.5% even. And they're in a tough spot. They're really doubling down on making this as much of a soft landing as they can. But the fact is what they've done to date has only had nominal impacts. We've started to see energy prices come down here in the United States. We're starting to see a bit of a housing correction. But the timeline for really solving this and getting things, quote unquote, back to normal is really looking 12 months out now.
And as you alluded to there, the big fear, I guess, from these aggressive moves that we've seen in the last few meetings could be that the US economy is tipped into recession. Do you think that's where we're heading, or is the US economy already there?
My opinion is that we're already there, and people are arguing over how many recessions can you fit on the head of a pin. It's a semantic question of what the definition is, but the fact is we're starting to see some pretty serious jobs constraints. We're seeing even some of the bigger tech companies like Meta and others starting to contain their workforce. We're seeing housing prices continue to go up, and it's important to remember that inflation doesn't. If we get inflation under control, it doesn't mean that prices go down. It means that the rate of their increases slows down. And at this point, we're in a situation where wages have not been keeping up with inflation recently, and we're going to be in a situation where that's going to continue to be true for a while. And so regardless of the technical definitions of recession, we're there right now, and we're going to be in this situation for quite a while.
Professor, thank you very much for your time this morning. That was Sultan Meghi joining us live from Washington, D.C.
WION is now available in your country. Download the app now and get all the news on the move.